There's a lot of sensationalism in the space, in precious metals, in risk assets, in debates of the dollar, the markets, the valuations. And I understand that. And I think folks like myself who are in the precious metal space or in hard assets or commodities are often kind of castigated as gloom and doomers or perma negative. And I understand that. There's sensationalism on the bull side and the bear side of just about every asset class. My background was in risk assets, and I am very cynical about markets and different forces in the world right now in the global financial markets. But I'm not a perma bear, and I think it's important, to get away from headlines and hype sometimes and look at the broader themes before we look at the individual, verticals, whether it's inflation, the dollar, precious metals, debt, tariffs. What I see, again, having been bullish in 2020 when we had unlimited QE and the Fed was giving us a fat pitch, or having been bullish in 2024 in the short term when Powell was cutting rates, it doesn't mean I'm bullish about the overall direction of global markets. In this sensationalism aside, what I'm really looking at is a theme of desperation. I see a lot of desperation in these big themes that would take an hour for each vertical, really. But when I look at the weaponization of the world reserve currency, the US dollar in 2022, again, regardless of what you think of Zelensky or Putin, I think that was a desperate act. I think the stable coin CBDC narrative of it's really centralization masquerading as evolution or kind of modernity, I think that's a desperate act. I think the market valuation right now, the S&P 500, which is really 40% led by 7 names, which are grossly overvalued with tremendous amounts of insider selling, is a desperate sign, not a positive sign. I think even the AI meme is a desperate sign. The tariffs as the External Revenue Service, again, debatable, but I think the tariff policies, as whipsawed as they are a sign of desperation. I think the BTFP plan during the banking crisis of 2023, the bailout, was a desperate sign. I think the notion of adjusting interest rates like a thermostat to maintain the economy is a desperate illusion. It's a desperate truism. I don't think it's true. I think the inflows and outflows out of the COMEX markets have been desperate signs. I think blaming the BRICS and the rest of the world on U.S. credit card spending as a nation, I'm talking kind of metaphorically the way the government spends like a drunken sailor, is a desperate sign. I think gold revaluation, which I've talked and written about, which is very possible, even the idea of a gold-backed U.S. Treasury, are desperate signs of a weak dollar and an unloved U.S. IOU. I think the war drums in the world, whether that's in the Middle East or Eastern Europe, whether that's Cambodia and Thailand or Pakistan, India, and certainly what we're seeing in the headlines in terms of Israel in the Ukraine are desperate signs. And I think there's a real resistance to the multipolarity in the world that's coming. America was really enjoying bipolarity with Russia from 1945, 1991. And then it had a kind of a unipolar power up until, I think, 2022, and it's resisting that. And I think gold is really calling BS on all of these different verticals. And again, this desperation, as I've argued like a broken record, really comes from a country that's over its skis in debt to the point of there is no solution now. It doesn't mean the end of the dollar, or the end of the world, or the end of the global financial system. It's just a repricing of the dollar and a reorganizing of the deck chairs on a Titanic, where global debt has gone from 30 trillion when I was in my 20s to 300 trillion today in my 50s. So, I'm a broken record on debt, and I've talked about it too many times, but this debt crisis, this sovereign debt crisis, this credit crisis is really the backdrop to all of these things, Daryl. So I guess to answer your question, I see symptoms of desperation. And again, the stablecoin is the most recent headline, which we can talk about, and central bank digital currency and centralization as a theme. But I see a country getting more desperate. America, I'm an American. I spent half my life in the US and overseas, but I'm not anti-American, quite the opposite. But we have to be objective about certain things, regardless of whether we're left, right, or center. The math and the facts kind of speak for themselves. There's a lot of tribalism in our thinking, and I think our thinking shouldn't come from our tribe. It should come from facts. And so, what I'm seeing is a lot of desperation. And again, whatever theme you want to pull on, I think we can find symptoms and signs of that desperation. The symptoms are obvious and objective. They're not just my opinion. You can take those facts. I mean, when I was in my 20s, global debt was 30 trillion. Again, now it's over 300 trillion. But we have a debt to GDP ratio in the US. Again, fancy numbers, 120% plus. That kind of debt to GDP we didn't have since World War II, but we're not at war. So what's the emergency? How did we get here? And I think, in 1971, right after I was born, US government debt was 247 37 billion. Today it's 37 trillion. And I think the difference between a billion and a trillion isn't just alphabetical. A billion seconds ago was 1997, but a trillion seconds ago was 30,000 BC. So our debt levels are extraordinary. And in the US, it's not just our government debt, household, people, men and women on the streets, Main Street America, it's 97% debt to income ratio. They don't have savings. They can't afford. The buy now, pay later things are everywhere. The credit card delinquencies, the auto delinquencies. And I think the cause is an addiction to the short-term euphoria of credit card spending. Again, a nation like an individual can go to the mall, so to speak, and feel great. You could take your Amex and go to Worth Avenue, Rodeo Drive, Madison Avenue, pick your stores, pick your street, and spend a fortune. And then you and your wife can look at the bill in 30 days and feel the permanent ruin of what debt does, and debt destroys. And I think that is a simplification, but that's exactly what America's been doing, spending beyond its means because it has a central bank to basically airbag the spending and support the bonds and the IOUs that it issues. And when you get into so much credit and so much debt, you get into a debt trap and you run out of liquidity to manage that debt. And the fancy examples or symptoms of that credit crisis we saw in 2019 with the repo crisis. We saw it in March of 2020 during the COVID crisis, which is really a liquidity crisis. Bonds were tanking and stocks were tanking in March 2020. In 2022 in the UK, we saw a gilt crisis that was a sovereign bond crisis for the Brits. In 2023, we saw this, massive banking failure in the US out on the West Coast, Silicon Valley Bank, etc. That wasn't a banking crisis. That was a liquidity crisis driven by the underlying assets of the bonds because we're in so much debt. And even in April of 2025, Liberation Day under Trump, that wasn't really a tariff crisis. That was a bond crisis. There was a dumping of U.S. treasuries. There was nobody at the treasury auctions based on that policy. So all of these are symptoms of a nation and a world just tremendously over their skis in debt. And, the cause is this notion that American politicians and policymakers believe that they can spend with impunity because they can always issue more IOUs as the world reserve currency. It's an exorbitant privilege. Other nations are forced to buy it. It's the world reserve currency, or take it, or trade with it, or save in it. And for decades, that exorbitant privilege was our privilege, your problem, our currency, your problem. That was the arrogant attitude. But because it's for various reasons, the rest of the world is slowly losing trust in that dollar. For one thing, we're just in so much debt because we have spent more to get reelected, to get popular, and then just dump the bill over to the Treasury or the Fed, and then the Fed adds a couple zeros to the balance sheet and pays for that debt, and then keeps interest rates artificially low. Banks issue more credit. Credit is how money is created, and we get into an inflation scenario, but our debt is trusted less. But the short answer to your question is, it's the fault of our policymakers. They are like a couple that spends too much with impunity and thinks they're immune from default. In a way, we are immune from default. We can always create money and create credit to monetize our own debt addiction, but we do that at the expense of the currency, at the expense of the dollar. And since 1971, again, in my lifetime, the purchasing power of the dollar has lost over 99% against gold. But $100 then would only buy you $13 worth of goods today. So that's an invisible tax that, all of us feel, regardless of the CPI scale, which has changed 22 times since 1980 to measure inflation, which I think is absolutely bogus and fictional, and most on the street accept that. But we all feel the inflation. We all feel the currency debasement. And that currency debasement is the direct result of the models and the fantasy that we can solve a debt crisis with more debt and then monetize that debt with money created ex nihilo, created out of nowhere. And I think even a 40-year-old or a 10-year-old, if they were seeing how that works, can understand that's too good to be true. That can't be sustainable, and it isn't. And so that's why we're seeing all these desperate measures, all these desperate kind words from our policymakers, all these promises, left, right, and center, that just can't hold. And I've joked many times, but again, Papa Smurf, the Wizard of Oz, no one can solve this debt crisis without some intervening austerity, some currency crisis, some type of reset, and frankly, some type of default. In a way, we're already defaulting on our debt because the yields on our IOUs and U.S. Treasuries really don't beat actual inflation, regardless of how it's reported. So we're running negative real rates, and we're effectively defaulting. But there's really no choice. We have to save the bond market because we live on debt. Those are our IOUs. We have a choice between that and the currency, and policymakers throughout history have chosen to save the bond market or the debt market at the expense of the dollar. And so that's why we're suffering actual inflation inflation that isn't reported at all accurately by the Bureau of Labor Statistics. And it really is the fault of our policymakers. They're very short-sighted. They're very political. They think 2-4 years out, not 15, 20 years out. The case for gold is obvious in my mind, and I didn't come to gold just by accident. I came out of risk assets, stocks and bonds as a hedge fund manager and a family office manager because I believe in gold. And I believe in gold for one simple reason. I don't believe in paper money because of the debt levels we discussed at the onset. Gold is indestructible and historically holds its value far better than paper money. That's not an opinion, that's corroborated by historical reality. Not only is it corroborated by history over the millennia, and look at the hockey puck of gold, it's no longer just a discussion about an inflation hedge or a dollar hedge or a market hedge. It's becoming a neutral strategic reserve asset. And central banks have been basically net stacking gold and net dumping those less valuable U.S. Treasuries since 2014. I mean, U.S. Treasuries are one of the worst performing assets of the year. They've lost 50% over the last 5 years, while gold has been up and to the right. Now, let me be clear. I'm not saying gold only goes in one direction. I'm not saying there can't be demand shocks to gold. And I'm not saying there can't be pullbacks in the price. But the secular direction of gold is obvious because the secular direction of the dollar is equally obvious. And in 2022, when we weaponized the world reserve currency as a matter of foreign policy, again, regardless of what you think of the war in the Ukraine, that was something we were warned not to do by many economists decades ago, including Obama in 2015. He didn't want to weaponize world reserve currency over Syria. Biden administration did. I think that was a watershed moment because other nations beyond just Russia, whose assets were frozen, started to think differently about a weaponized neutral reserve asset. And that's when the BRICS rise really took momentum and the demand for gold just skyrocketed. Prior to 2022, the average central bank purchase per bank of gold was about 118 tons. After the weaponization, that went to 290 tons. And you've seen just gold up and to the right by central banks outside of the US purchasing gold because they don't trust the dollar, not only because it's so indebted, but because it's weaponized. And I am no fan of the BIS, which is the mother central bank of all central banks. It's like the Death Star of all central banks here in Switzerland and Basel. Even they have made gold a tier 1 asset because they know it's a better store of value than the US Treasury, the US 10-year. And the term premium on US Treasuries, the 50-year average for longer duration Treasuries is a 1.5%. Right now it's 0%. And for it to get to 1.5%, we'd have to raise rates to 6%, which we can't do because if we raise rates to 6%, bond prices would go down 30%. So the point is US Treasuries are kind of a lame duck now. The world's catching on. The BRICS are catching on. That's why we saw these massive inflows and outflows out of the COMEX. That's why we see an exchange in Shanghai and in St. Petersburg now, the SPIMEX, because you can't have a gold price set in London or New York that's different than the one in Shanghai and St. Petersburg. And the Chinese and Russians are many good and bad things, but they know one thing, that the gold price and the silver price was grossly manipulated on these New York and London exchanges. That jig is up now. And Chinese demand for gold went from 15 tons of ETFs last year to 60 tons. So, there's a massive movement for gold. The case for why gold is pretty obvious. And the price movement is fairly obvious. I mean, people in my business and the private wealth sector in Wall Street for the last 25 years said gold was too volatile. Yet in the last 25 years, gold has outperformed even this S&P bubble. It's returned 11x its value, and the S&P's only turned about 7. So it's still not the peak in real terms or inflation-adjusted terms that it was in 1980. For that, we need gold at 4,800. So still relatively inexpensive. And so for folks who want to buy gold, it's a great question. It depends on, in our offices in Switzerland, we have very high minimums. We have high net worth clients, but 99% of the people we speak to could never be our clients. We still talk to these people in platforms like this because they should own gold, not to get rich quick, but to prevent themselves from getting poor because of the debasement of their dollar. So whether you can afford an ounce, and an ounce is very expensive, I get that, especially in a country that's suffering from inflation and wages is not catching up and cooling and unemployment rising and half employment doubling. In other words, people just only able to find part-time work. So they think, great, you tell me gold will help me protect from a devalued paper US currency, but I don't have the money to buy an ounce of gold. Then you have to buy grams or milligrams. But everyone has to think, A, do they see the need for gold? I think the evidence is fairly strong. And B, how much can they afford it in small increments? And that's a choice I would highly recommend, not because it'll outperform NVIDIA tomorrow, but because it'll hold its value better over the long term. You've got to think of gold as a long-term play, not a get-rich-quick scheme.